Venezuela's economic collapse was the result of a combination of oil dependence, poor economic policies, political decisions, and external shocks, all of which built up over many years rather than happening overnight. A central cause was extreme dependence on oil. Venezuela has the world's largest proven oil reserves, and for decades, oil exports provided most of the government's revenue and foreign currency. When oil prices were high, especially in the 2000s, the government spent heavily on subsidies and social programs instead of saving or diversifying the economy. When global oil prices fell sharply after 2014, government income collapsed, leaving the state unable to pay for its commitments. Another major factor was mismanagement and politicization of the oil industry. The state-owned oil company, PDVSA, was increasingly used for political purposes rather than efficient production. Skilled workers were fired and replaced with loyalists, investment declined, and oil output fell dramatically. As production dropped, export earnings shrank further, worsening the crisis. The government also imposed strict price controls and currency controls. Price controls were meant to make basic goods affordable, but they discouraged production because companies could not cover costs. This led to shortages of food, medicine, and other essentials. Currency controls created multiple exchange rates, encouraging corruption and black markets, while making imports difficult for businesses. To cover growing budget deficits, the government relied heavily on printing money. With falling oil revenue and limited access to international borrowing, the central bank created money to finance spending. This caused hyperinflation, where prices rose so fast that wages and savings became nearly worthless, destroying purchasing power and public confidence in the currency. Political instability and loss of trust further accelerated the collapse. As democratic institutions weakened, investor confidence disappeared, capital fled the country, and businesses shut down. Millions of Venezuelans emigrated, reducing the workforce and worsening economic decline. International sanctions also contributed, especially in later years. While sanctions were not the original cause of the collapse, they reduced Venezuela's ability to sell oil, access global financial markets, and import essential goods, making recovery more difficult. In summary, Venezuela's economy collapsed because it relied too heavily on oil, failed to diversify, mismanaged key industries, distorted markets with controls, financed deficits by printing money, and lost institutional credibility. These factors combined to create shortages, hyperinflation, mass poverty, and one of the worst economic crises in modern history.